In this video, we will do a capitalized cash flow. A capitalized cash flow uses historic financial information to calculate the value per share of a company. We will start with the home page and click on the Research menu, which takes us to the submenus within Research, and we will select the Valuation submenu, and from there the Capitalized Cash Flow option. We can minimize the menus by clicking on the triple and double arrows. In this example, we will do General Electric. We can calculate using an average or a weighted average over the number of years that we choose. We will try a weighted average, which gives more weight to the more current years, and we will calculate over a 10-year period. So what we're doing is using the last 10 years of financial data to calculate the value per share for General Electric. We do not have a user-defined weighted average cost of capital, but we have done some predefined costs of capital. You can see that the predefined with the warning message, please do not rely on these values, for General Electric was generated at 8.99. We can change this, for example, if we choose, and we will use 7 as the weighted average cost of capital, or 7%. We can calculate the capitalized cash flow by clicking on the button. As we said, the capitalized cash flow looks at the historical data over time to see how the company has fared. Capitalized cash flow is good for a steady state company with a predictable growth rate. In this example, the average EBITDA or cash flow for General Electric for the last 10 years is $43 billion, approximately $43 billion. You can see a low of 36 and a high of 60. We can apply any normalizations or adjustments to generate a normalized EBITDA. We use the tax rate that's generated from the financial statements, or we could adjust this tax rate as well, which we will do in a minute, to generate a net operating after-tax cash flow. If there's sustaining capital that we wish to input, we can calculate the tax shields on the sustaining capital, and we can add in any incremental working capital requirements as well to generate a discretionary cash flow when all of these are totaled. The capitalization rate is the inverse of the cost of capital to give us a capitalized cash flow for the company, again seeing the low and high over the time period that we're dealing with. We can then use the capitalization rate to determine the present value of the tax shields as well too. If the company has redundant assets or any other adjustments, we can include them at this time to generate an enterprise value for the company. The enterprise value is the combination of the debt and equity in the company. If the company has interest-bearing debt from the financial statements, we grab it here to derive a calculation for the en-bloc fair market value of the shares. We can divide by the number of shares outstanding to generate a value per share. In the updated version, we will also include preferred shares in the calculations. This version doesn't include the preferred shares at this time. Preferred shares would be removed before the common equity calculation is done. As we mentioned, we can change the tax rates. So for example, if the tax rate was 15.8%, you can see the impact that that has on the value per share. Or we can change the cost of capital and recalculate. So we can use this as a what-if tool to determine the range of value per shares we would expect for a company given the cash flow, the tax rate, and the cost of capital that we're looking at for that company.